Hello, investors! Although investing in the financial markets may seem like one of the riskiest aspects of managing your money, it also has the potential to be the most lucrative. Investments are one of the only methods to beat inflation and increase your spending power over time. In this video, we'll go over some investment tips new investors can use to begin their journey to financial freedom. The first tip: understand your investment options. One of the best ways to create long-term wealth for you and your family is through stocks, which offer you a small ownership part in a company. However, they may be quite volatile in the near term, so you should aim to keep them for at least 3 to 5 years, preferably longer. Bonds are a solid source of income for investors, and holding them will result in smaller gains but fewer risks than investing in stocks. Bonds are the perfect way to balance out a portfolio of volatile equities, since they vary far less than stocks do. A mutual fund is a collection of investments that are owned by several individuals and normally consists of stocks or bonds, though occasionally both. You purchase stock in the fund, which is frequently spread among a number of investments, lowering your risk and perhaps even raising your returns. A mutual fund is a fantastic tool for novice investors to get large market returns. Exchange-traded funds, or ETFs, are quite similar to mutual funds in that they allow you to invest in stocks, bonds, and other types of assets. They also have a few advantages over mutual funds. ETFs often have relatively low management costs, which reduces the cost of ownership compared to mutual funds. ETFs can also be traded during the day like stocks. ETFs are a good way for even inexperienced investors to make good profits. Consider retirement accounts. The employer-sponsored retirement plan you have access to through your employer's benefits package, probably a 401k, is for many people the ideal place to start. The money you put into a 401k plan with each paycheck will increase tax-free up until the time you start taking withdrawals at retirement. Many firms even provide matching payments up to a specific percentage for employees who enroll in their sponsored plans. With a traditional 401k, you may deduct your contributions from your wages so that you only have to pay taxes on the money when you eventually withdraw it. A Roth 401k offers tax-free withdrawals after years of growth, but contributions are subject to tax. Consider starting a regular IRA or a Roth IRA if your workplace doesn't provide a 401k. A traditional IRA and a 401k are comparable. Money is invested tax-free, allowed to grow over time, and is withdrawn tax-exempt upon retirement. Contrarily, when you contribute to a Roth IRA, your taxable income grows tax-free and is not subject to taxation upon withdrawal. Diversify to reduce risk. One of the first things you should think about when beginning to invest is your risk tolerance. Many investors leave the market when it falls, as it occurred in 2020, or so far in 2022. However, long-term investors frequently view such downturns as an opportunity to purchase equities at a reduced price. Investors who can endure such downturns may benefit from the market's historical average yearly return of roughly 10%. However, you must be able to remain in the industry when times are tough. It all boils down to diversity if you want to lower your risk as a long-term investor. When you are young and your withdrawal date is far off, you can be more aggressive with your stock allocation. Start reducing your risk as you get closer to retirement or the time you want to take money from your accounts. In order to avoid suffering significant losses during a market downturn, your diversification should gradually become more cautious. An index fund allows investors to build a diversified portfolio fast and simply. An index fund passively holds every stock in an index as opposed to actively trying to choose stocks. Although they won't completely remove the danger associated with stock investing, investors who hold a diverse range of businesses reduce their exposure to the risk associated with owning just one or two unique firms. It should not be difficult for you to locate an index fund in your 401k plan, as they are a common option. A target date fund is another popular passive fund type that can lower your risk aversion and simplify your investing process. As you come closer to retirement, these set it and forget it funds automatically rebalance your holdings to a more conservative combination. As you get closer to your date, they often switch from a portfolio that is more heavily weighted in equities to one that is more heavily weighted in bonds. Balance long-term and short-term investments. Money market accounts, high-yield savings accounts, and certificates of deposit will be the most practical if you're concentrating on short-term investments. Those you can access within the next 5 years. Your money will be there when you need it, since these accounts are FDIC guaranteed. Short-term stock market investments are often not a good idea, since in the event of a downturn, the market may not recover for a while. However, the stock market is a terrific option for long-term investments and may provide you with excellent returns over time. You have a number of alternatives, as index funds, mutual funds, and exchange-traded funds all provide stocks, bonds, or both. Whether you're saving for retirement, planning to purchase a house in 10 years, or getting ready to pay your child's college tuition. With the increasing number of brokerage accounts customized to your specific requirements, getting started is simpler than ever. With brokers lowering commissions to nothing and fund providers continuing to reduce their management costs, investing in stocks or funds has never been more affordable. Avoid novice mistakes. Being overly engaged is the first mistake that novice investors frequently make. According to research, actively traded funds often perform worse than passive funds. If you refrain from monitoring your accounts more frequently than a few times each year, your money will grow more, and you'll have peace of mind. Failure to utilize your accounts as intended poses another risk. Tax and investment benefits are available through retirement plans like 401k and IRA accounts, but only for retirement. If you use them for nearly anything else, you'll probably owe taxes and face additional penalties. Many individuals are hesitant to invest, but if you master the fundamentals, a prudent strategy may help you accumulate significant wealth over time. The first financial move you should make is to start investing. This will help you set yourself up for a lifetime of financial stability and a happy retirement. Please like and subscribe to the channel for more content on investing.